Welcome to the latest Motley Fool Scoreboard. I'm on in Chalk Balloon. We've got longtime fools, Sunmeet Deo and Tom King, giving a 1 to 10 rating to a restaurant I still haven't tried yet, but I know Sunmeet has and has strong opinions. It's Wingstop, ticker symbol WING. There's one next to a Dairy Queen near me. May have to pair the wings in a Butterfinger Blizzard soon. So hoping to do that before taping, but I missed out. Let's talk about the business first, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Both of you have 8s, Tom.
Yeah, I gave it an 8 based on the return on invested capital its average store makes. While we don't know what profit the stores make, we do know they cost about $500,000 to set up, excluding real estate and pre-opening expenses. And the average annual revenue per store is about $2.1 million. I don't know why they exclude the real estate and setup expenses from that cost to open a store. But if we assume, say, $1 million to set up a store and a 10% profit margin on $2.1 million in revenue, that's still a very decent 21% return on investment for franchisees.
Yeah, I also gave it an 8, and I like the simplicity of its business model. They use a few ingredients to make chicken wings, tenders, sandwiches, sodas, and fries. Their stores have a small footprint with high average unit volumes, AUVs, with an average store size of about 1,700 square feet, AUVs of about 2.1 million, and limited in-store dining in a store that only really needs about 4 workers to operate. Their food is available for delivery or carry out, and their app makes it very easy to order, and most of their business is actually driven from their app.
And they have all the commercials now. That 500,000, Tom, to set up is like, yeah, wait, excluding real estate and pre-opening expenses. Like, come on, help us out here.
That's kind of important. Like, I don't know how you run a store
without
a real estate.
Most important parts of.
Yeah, it's like, okay. I mean, like, your estimate of what you're adding to it, right, is like more than the 500,000. It's like, all right.
You still get to a pretty good level, even with that doubling the opening costs. So, yeah.
Right. But I hate that it's a guessing game. Let's talk about management. A 10 is Warren Buffett. A 1 is Homer Simpson. Sunmeet's at a 7. Tom, you're lower at a 5.
Yes. So on the good side, a substantial portion of management's equity compensation is dependent on the achievement on return on capital targets measured over a 3-year period. So this incentivizes them to create value rather than just grow. But on the bad side, management owns just 0.5% of shares outstanding, and no members of management have bought stock on the open market in the last 3 years.
Yeah, so I gave it a little bit higher than Tom. I think the management team is pretty strong. They actually went through a recent transition at CEO, but the current CEO was the prior COO. So again, a homegrown talent rising into the ranks of the management team, keeping it consistent, and even through the transition, the results have still been impressive.
For financials, a 10 is a fortress. A 1 is yikes. Both of you have 8s, Tom.
Yeah, a solid 8 on financials. Wingstop's revenue is primarily from royalties on sales and advertising fees paid by franchisees who own and operate 2,500 of the 2,563 Wingstop stores in existence. I spoke about the store-level return on investment earlier, and at Wingstop's level as the franchisor, their return on invested capital was 35% in 2024, and it has been improving steadily over the last decade from 11% in 2014.
Yeah, as Tom said, their revenues are recurring from the royalties and fees that they pay. They are receiving from their franchisees. And just keep in mind, Wingstop is a franchisor, so it doesn't put in the capital investment into the stores and in opening the stores. They just get royalties. And so it's an asset-light franchise model, which I like, and keeps their financials at and their margins very high. I don't love that they do have about $1.2 billion in debt, but their net debt to EBITDA ratios have been coming down, and their interest coverage ratio is sufficient at 8 to 9 times.
Let's move on to valuation now, Tom. How well will Wingstop stock do over the next 5 years? How safe is it? 10's a sure thing, 1's a lottery ticket.
I mean, I think 10% to 15% is a reasonable expectation. The price of a share has declined 36% over the last 6 months, and the price to earnings ratio at 68 is close to the lowest it's been in 10 years. In 2016, 2017, that multiple was in the 50 to 60 range. But the important thing to note is that Wingstop's return on capital has risen, which justifies a higher price to earnings multiple today. With regards to the safety score, I give it an 8. It sells chicken wings primarily, something that doesn't really lose demand even in tough economic times. But the big uncertainty right now is the impact of the avian flu on chicken prices. I mean, prices haven't risen yet, but that may change.
Yeah, I think that it's reasonable to also expect 10 to 15% returns over the next 5 years for the stock. Consensus projects 3-year revenues of 17% plus, EPS of 20%, and its 3-year forward PE is about 34 times. So consensus estimates are baking in a decent amount of growth, but even with the shares they're baking in a lot of growth, even with the shares down as of late. They were up quite a bit, as Thomas said. As a company continues to roll out stores and maintain same store sales growth and higher AUVs, which I like to see, I think the stock can perform very well. They're also rolling out internationally, which has been doing pretty well. And as far as the safety score, I have it as a solid 8 for many of the reasons that Tom said as well. But also given the recurring nature of the revenues, it's an asset-light model, as I said. It pays a dividend as this very simple and clean business model. Also, in its specific niche of selling wings and chicken, there's not many competitors. So they have a good, solid foothold in what they offer and a good value proposition.
Not many competitors. I'm going to be curious what you all say to top it then. Tom, is there a company in Wingstop space you like better?
I mean, I'd have to say Chick-fil-A, but it's private. I mean, I know people who've broken down in tears on their way to a Chick-fil-A on a Sunday.
Oh, every time.
Yeah, Chick-fil-A is definitely one of the cream of the crops of the restaurant industry. As far as publicly traded, everyone that ever listens to me on our shows knows that I'm a huge fan of Chipotle. Still, I'm a huge fan of Chipotle. I think it's like the model of fast casual. And even just restaurants in general, everything they do is very good. As far as the stock, it's probably still a little richly valued, and it still has a lot to prove to continue to grow. But I still like it as a business.
Thank you to both Sunmeet and to Tom. They've given Wingstop a solid overall score of 7.5 out of 10, short of the 8.0 that would force me to own shares, but still pretty darn good. And regardless, I've got to try the wings. Sunmeet swears they're really good, and I know they can't be worse than those tiny Buffalo Wild Wings wings, and he confirms that for me. Yes, shots fired at one of our old Fool favorites before private equity took it. Look out for a new Scoreboard every market day at 7 p.m. Eastern. Next up is something good. Till then, Fool on. Five Guys for me is like the thing. So
my only criticism of big burgers is that they should make them wider, not taller. Because if you make it tall, you can't get your mouth around it, and then when you bite it, the things fall out.
Yeah.
Make it flat and wide, but then it becomes a sandwich, I guess. So